On the left, Matrimony.com stock breaks out with an 11.8% single-day surge. On the right, the driver, a 127% year-over-year jump in profit after tax for Q1 FY27. That profit jump is anchored by a sharp expansion in EBITDA margin, which moved from a suppressed 12.4% up to 20.1% in a single quarter. This chart tracks the direct correlation between that margin expansion and top-line growth, where billing volume grew in the double digits. To understand how a single tech firm scales those billings, we have to look at the total addressable market. India sees 10 to 12 million weddings every year, with an estimated 60 million active individuals looking for a life partner at any given time. Matrimony.com dominates the specific digital space. They currently capture an estimated 60% market share of online matchmaking in India. But their operations are hybrid. They back their digital platforms with a physical footprint of over 130 retail storefronts, allowing them to penetrate deep into regional micro-markets where trust is built offline. The revenue structure is highly concentrated. 99% of their top line comes directly from subscription-based matchmaking, while only 1% is derived from broader marriage services and new ventures like Love.com and the gray-collar job portal, ManyJobs. A 25-year brand moat combined with Q1's sudden margin expansion provide evidence that management's guidance, a 5-year horizon of double-digit growth, is actively materializing. Let's run the valuation math. At a current price of 537 rupees, Matrimony operates as a microcap with a total market cap of 1,111 crore. This scale measures current price against Trendline's estimate. The market prices the stock at 537, but intrinsic value sits higher at 592.5. That gap represents a 10.3% one-year forward undervaluation. This is anchored by a forward PE multiple of 23. However, looking strictly at the historical beta reveals significant drag. Across FY25, revenue growth was entirely stagnant, posting a minor 0.91% increase. The bottom line took an even harder hit, with profit after tax declining by a severe 24.5% over the same fiscal year. These decent returns have been actively suppressed by the company's aggressive, sustained marketing spend to acquire users in a fragmented market. Factoring in growth expectations, the price-to-growth, or PEG ratio, currently stands at 1.9. A PEG ratio near 2 implies the market has already priced in significant current growth, meaning future earnings estimates must deliver to justify further multiple expansion. The stagnant metrics of FY25 and FY26 are rearview mirror data. The sudden margin unlock and explosive profit surge in Q1 forces a complete reevaluation of the company's forward trajectory. This balance sheet scale illustrates the company's absolute safety net, zero weight on the liability side. Matrimony is completely debt-free. On the asset side, they maintain a massive liquidity cushion of 324 crore rupees in pure cash. Because baseline debt is absolute zero, standard quarter-over-quarter debt reduction metrics do not apply here. Subtracting that 324 crore cash pile from the 1,111 crore market cap reveals the true cost of acquiring the business. This calculation yields an enterprise value to EBITDA multiple of roughly 12.3 times, an attractive entry point. The cash engine itself is highly efficient, generating 44 crore rupees in free cash flow. In this specific software-as-a-service model, cash flow from operations mirrors and often exceeds the reported net profit because capital expenditure remains minimal. Negative working capital funds the business. Physical inventory days are absolute zero. Debtor days are also virtually zero. Deferred revenue locks in future earnings. A zero-debt capital structure, combined with an advance payment cash engine, limits downside risk while generating the exact capital needed to fund their own aggressive reinvestment. Turning to governance, institutional holding remains steady at 24.4%, showing sustained smart money interest. But this shareholding pie chart reveals one clear forensic red flag. The promoter has encumbered, or pledged, 27 lakh shares of their equity. That pledging risk must be weighed against management's highly positive track record of capital allocation. Instead of hoarding their 324 crore cash pile, Management routinely deploys it to fund aggressive share buybacks, directly increasing the value of remaining shares. They supplement those buybacks with a direct shareholder reward, maintaining a 5 rupee per share dividend payout. A check of their auditor fees shows no irregularities. Auditor compensation scales appropriately with revenue, passing a key test of financial transparency. Customer concentration risk is non-existent. Their revenue is infinitely fragmented across millions of individual retail subscribers. The price-to-book ratio sits at 5.38 times. Standard banking metrics like gross NPAs or net interest margins are entirely irrelevant to evaluating this tech platform. When benchmarked against its primary market peer, InfoEdge, Matrimony trades at a substantially lower PE multiple, despite holding a near monopoly on its specific niche. While the encumbered promoter shares require continuous monitoring, the proactive return of excess cash to minority shareholders demonstrates strong, transparent governance. This one-year daily candlestick chart maps out the market's technical realization of these fundamentals, plotting the price action against the 20, 50, and 150-day moving averages. The stock has executed a massive recovery, climbing 47.5% off its 52-week low of 364 rupees. That breakout is validated by high volume bars, confirming that institutional capital is driving the momentum, not retail speculation. The current price action has crossed cleanly above all 3 moving averages, flipping the technical trend from bearish to highly bullish. The primary fundamental headwind threatening this trajectory is demographic shift. Free, casual dating apps like Bumble and Tinder present an ongoing risk of cannibalizing younger demographics before they enter the traditional marriage market. Technologically, the rise of AI-driven, highly personalized matchmaking alternatives could pressure Matrimony's ability to maintain high paid subscriber growth. Weighing these risks against a 10.3% forward undervaluation and an absolute zero debt balance sheet, the data supports a clear hold or accumulate on dips verdict. If the company compounds earnings at management's guided 12 to 15% rate and the market maintains a 25 times multiple, a 15% annualized return from today's entry price becomes a plausible mathematical outcome.